Imagine you check your portfolio on a random Tuesday morning and you're down 12%. The news is screaming about war, inflation, and global uncertainty. You're paralyzed. You don't know whether to sell, hold, or buy more. You're stress-eating breakfast and wondering if maybe your cousin was right about buying gold and moving to the mountains. Now imagine that at that exact same moment, a United States congressperson, someone with access to classified intelligence briefings, closed-door defense meetings, and a network of lobbyists that would make your head spin, is sitting in their office, calmly, clicking buy. That contrast should bother you, and today we're going to talk about exactly why. My name is Smith, and I spend way too much time thinking about how money actually moves in this world. If you're someone who's tried to invest during geopolitical chaos and felt like you were playing poker against people who could see your cards, hit subscribe and give this video a thumbs up. Because what we're about to get into is not a conspiracy theory. It's public record, and it's going to change how you think about investing during wartime. Let's talk about the so-called Pelosi Strategy. Now, before I even get into the specifics, I want to be clear about something. This is not a political video. I don't care what side of the aisle you're on. Republicans, Democrats, they're both doing this. This is about the structure of the system and what ordinary investors can learn from it. Because here's the thing. Whether you think it's fair or not, these disclosures are public, and public information used intelligently is called strategy. So what is the Pelosi Strategy? It's a term that went viral on Reddit and financial Twitter, referring to the investment moves made by Nancy Pelosi and her husband Paul Pelosi. Their stock trades, which are publicly disclosed under the Stock Act, have consistently outperformed the S&P 500 by a margin that, statistically speaking, is very hard to explain with luck alone. According to data analyzed by Unusual Whales, a financial tracking platform, congressional members as a group outperformed the market by around 6% in recent years, and certain members did far better than that. Now, you might be thinking, well, 6% isn't that wild, but let me put that in dollar terms for you. If you had $100,000 invested and you consistently earned 6% more per year than the average investor, over 20 years, that's the difference between roughly $320,000 and over $600,000. Same money, same time, just better information about where to put it. That's not a small edge, that's a life-changing edge. Here's what most people don't realize about investing during wartime or geopolitical conflict. It's not just about which defense stocks go up. The average retail investor thinks, oh, there's a war, I'll buy Lockheed Martin. And sure, sometimes that works, but that is surface-level thinking. The real money, and I mean the quiet, consistent, unsexy money, moves through a much more complicated web of sectors. And the people who know where conflict is actually heading because they've sat in the classified briefings, they're buying into that web months before the rest of us even see the headlines. Let me give you a framework for understanding this, because the psychology here is just as important as the math. When conflict breaks out, whether it's a regional war, a full-scale military engagement, a sanctions crisis, retail investors do one of two things. They panic and sell, or they FOMO in and buy the most obvious play, which is usually already priced in by the time they get there. Both of those are losing moves, and Wall Street, and apparently Capitol Hill, is counting on you to do exactly that. There's a concept in behavioral economics called the narrative fallacy. If the idea that human brains are wired to latch on to simple stories and miss the complex reality underneath. The simple story of war equals defense stocks is a narrative. It feels logical, it's incomplete, and it costs people money every single time. Now, let's get into what politicians have actually been buying, and I want to be specific here because vague claims aren't useful to you. During the current conflict, and we've seen this pattern repeat across multiple geopolitical crises, disclosed congressional trades show a consistent rotation into a handful of sectors. Defense and aerospace, yes, but also cybersecurity, semiconductor manufacturers with government contracts, liquefied natural gas companies, and interestingly, certain healthcare and pharmaceutical firms that supply military logistics. Think about that last one for a second. Healthcare and pharma. Most people don't connect those to wartime investing, but when you understand that modern military operations require enormous medical supply chains, field hospitals, trauma equipment, vaccines for deployed troops, it starts to make sense. The politicians sitting on armed services committees or intelligence committees know which contracts are being awarded. They know before the press release. They know before the stock moves. Now, look, I want to address the legal elephant in the room. The Stock Act, passed in 2012, was supposed to prevent exactly this kind of insider trading by politicians. Members of Congress are required to disclose trades within 45 days. But here's the thing. 45 days is a long time in the market. A stock can move 20, 30, even 40% in 45 days. By the time you see the disclosure, the trade has already paid off. The law created transparency in theory. In practice, it created a 45-day legal head start. According to data compiled from market history going back to World War II, and I want to be careful to say this is historical data, not a prediction, markets have shown resilience after the initial shock of conflict. The initial sell-off, which is what the news cameras focus on, is usually the worst of it. The people who sell during that panic lock in their losses. The people who buy during that panic, with discipline and a thesis, tend to do significantly better over the following 12 to 24 months. This is exactly the dynamic that sophisticated investors and apparently a number of U.S. politicians understand and retail investors systematically miss. Let me give you a practical action plan because this content is worthless if you don't know what to do with it. Step 1. Set up a free account on at least one congressional trade tracking platform. Quiver Quantitative has a solid free tier, Unusual Whales has good social media integration, Capital Trades is clean and easy to navigate. Pick one and spend 20 minutes learning how to filter by sector and by committee membership. That committee membership filter is important. You want to weight disclosures from members who sit on armed services, intelligence, and foreign relations committees more heavily than disclosures from someone on the agricultural committee when you're analyzing a military conflict. Step 2. When you identify a sector with multiple overlapping disclosures, don't rush in. Do your own secondary research on 2 or 3 specific companies in that sector. Understand their revenue exposure to government contracts, their current valuation, and how similar companies performed in previous comparable conflicts. This takes maybe 2 to 3 hours per sector. You're not trying to become an analyst. You're trying to do enough work to have conviction without having to rely purely on mimicry. Step 3. Size your position appropriately. This is where most people blow it. They get excited, they over-allocate, and then when the position doesn't move immediately, they panic sell. A reasonable allocation for any single thesis derived from this kind of unconventional signal is somewhere between 3% and 10% of your investable portfolio. Enough to move the needle if you're right, not enough to ruin you if you're wrong. Step 4. Set a time horizon before you enter. Are you making a 6-month trade or a 3-year investment? Knowing this in advance prevents the emotional decision-making that kills returns. If the stock drops 15% in month 2 and your thesis is intact and your horizon is 3 years, that's a buying opportunity, not a reason to panic. If your horizon is 6 months and you're down 15% and the macro picture has changed, reassess, but the key word is reassess with logic, not react with emotion. Here's the thing about all of this, and I want to leave you with something that goes beyond the tactics. The reason the Pelosi strategy, or whatever you want to call it, resonates so much with people isn't really about Nancy Pelosi. It's about a feeling that the game is rigged, that there are people with information you don't have making moves you can't see, profiting from chaos while ordinary people suffer. And look, that feeling isn't entirely wrong. The information asymmetry is real, but the response to that asymmetry isn't to give up. It's not to rage on the internet. The response, if you're being smart about it, is to use every legal tool available to close that gap. And the Stock Act disclosures, whatever their flaws, whatever the delays, are one of those tools. They handed you a window, even if it's a small one with a 45-day delay. Most people look through that window and say, That's interesting. A few people look through that window and say, how do I position myself around what I'm seeing? Be the second person. You don't need to be a congressman. You don't need a Bloomberg terminal. You don't need to know someone in Washington. You need a free account on a disclosure tracker, a basic understanding of which sectors benefit from which types of geopolitical events, the emotional discipline to size positions correctly and hold your convictions, and the intellectual honesty to know when your thesis is wrong. That's it. That's the whole playbook. The market doesn't care about your feelings about the system. It doesn't care if you think it's fair. It rewards people who adapt, who learn, and who act with clarity when everyone else is acting with fear. So the next time you wake up to war headlines and a red portfolio and the urge either to panic sell or do nothing, remember that somewhere a congressional staffer is filing a disclosure. And 45 days from now, you could be reading it. The question is whether you'll be ready to do something about it. If this video gave you a new way to think about geopolitical investing, drop a comment below telling me which part hit different. And if you want to go deeper on wartime sector rotation and the full historical data behind market behavior during conflict, that video is coming next. Make sure you're subscribed so you don't miss it. See you in the next one.